This week, the Bay Area housing market is signaling two distinct and strategically significant forces. One signal, mortgage rates have eased modestly from spring highs, a shift that, if sustained, materially alters purchasing power in high-cost metros. The other, sharply rising carrying costs, notably insurance, higher local taxes, and added fees in higher-risk neighborhoods, are lifting the true cost of ownership. Put differently, national rate volatility is normalizing, while local cost pressures amplify the trade-offs among moving, upgrading, or staying put. That split plays out differently for first-time buyers, prospective sellers, investors, and renters weighing buy versus rent. So what does this mean for household wealth and housing plans? A genuine window of opportunity or a costly trap?
Welcome to Bay Area Dayshi Real Estate Weekly for August 11th to the 17th, 2025. We're breaking down the 5 key developments you need to understand, from a surprising mortgage rate disconnect and a rental market on fire to a deepening insurance crisis, a split decision in the East Bay, and a major tax shift that could change whether you decide to move or stay.
First up, a modest dip in mortgage rates is appearing, but it may not translate into the buying wave many had hoped for. This past week, the average 30-year fixed rate fell to about 6.67%, the lowest level since early April. The immediate market response was a sizable 23% week-over-week spike in refinance activity, as homeowners with higher recent rates sought relief. New purchase applications, however, barely budged, up roughly 1%, underscoring a persistent lock-in effect. Many owners with pandemic-era sub-4% loans are unlikely to trade down their financing. In jumbo-heavy Bay Area price tiers, buyers generally need a sustained move into the mid-6% range or better before affordability and confidence shift meaningfully. For the Dayshi community, that split is strategic. In jumbo price submarkets, Fremont, Cupertino, Sunnyvale, a half-point swing in rates can expand buyer purchasing power by tens of thousands of dollars, but only if insurance and tax assumptions remain stable. Bay Area median prices have long been multiples above national medians, metro medians north of $1 million versus national medians in the low 400,000s, so small rate moves have outsized budgetary impact here. While modest, sustained rate falls previously revived bidding, 2019 to 2020, today many owners remain locked in to sub-4% pandemic loans, so the current dip is producing far more refinances than new purchase demand. The tactical takeaway: first-time buyers should identify the sustained rate that makes a deal workable, often mid-6% territory. Move-up buyers can bridge gaps via negotiated seller concessions or temporary buy-downs. Investors must model jumbo financing and refinancing timing precisely. Across the board, require lender underwriting to use conservative insurance and tax estimates before committing to an offer.
While purchase activity stalls, the rental market is moving in the opposite direction, re-accelerating, particularly along core tech corridors. Rents are climbing in tech corridors, driven by renewed hiring and clearer office return policies. One-bedroom asking rents in San Francisco are up double digits year over year and are approaching pre-pandemic peaks, while suburban hubs Sunnyvale, Cupertino, Santa Clara now command rents that exceed many U.S. markets by a wide margin. Unlike the more muted national rental recovery and many secondary markets, the Bay Area's rent gains reflect concentrated job growth and chronically constrained supply. The near-term trajectory hinges on tech hiring. Continued gains will push rents higher and erase concessions. Any slowdown will show up here first. Practically, rising rents narrow the lease versus buy calculus and can tilt some households toward purchasing. For investors, proximity to transit and major employers remains a high-value attribute, but underwriting must factor in higher insurance, HOA, and tax costs. Now a critical issue that can derail a closing or materially strain household budgets: the escalating home insurance crisis. This week, S&P Global Ratings downgraded State Farm's California homeowners book to A-, citing accumulated wildfire losses and rate inadequacy, while the state's insurer of last resort, the FAIR Plan, has grown past roughly 591,000 policies statewide. Both data points are a clear signal of market strain. This is not an abstraction, it's a binding market constraint with measurable financial effects. Unlike states where catastrophe exposure is spread across many regions, California's concentrated wildfire risk has prompted a retreat by carriers, lifting premiums, widening deductibles, and pushing more homeowners into the FAIR Plan or excess markets. Locally, the impact is clearest in hillside and canyon neighborhoods favored by many Dayshi families. Higher insurance costs reduce borrowing capacity, complicate closings, and can shrink the buyer pool for higher-risk properties. Expect tighter underwriting, larger catastrophe deductibles, and continued reliance on the FAIR Plan until carriers rebuild capacity. Practically, buyers should secure binding insurance quotes well before contract contingencies expire and bake those premiums into affordability models. Sellers can improve marketability and sometimes price by documenting fire hardening and mitigation work. Investors must stress test cash flows for elevated insurance and potential assessments. In short, improving a home's insurability, creating defensible space, retrofit measures, now directly influences market value.
Turning to the East Bay, July data show a market with a clear split personality. In the single-family segment, competition remains firm in core Dayshi suburbs. Fremont's median single-family sale price ran near $1.59 million in the May to June window, with pending times around 19 days and average sale-to-list ratios near 104%. Dublin showed modestly slower market velocity, with typical marketing times in the low 20s, roughly 22 to 25 days. The attached home market, condos and townhouses, tells a different story. Fremont's attached median sits near $800,000. Properties typically linger about a month or longer, and closings often occur at or marginally below list. Active inventory for attached homes is higher than for single-family stock, softening bid pressure. That bifurcation creates distinct tactical opportunities. Demand for single-family homes in top school districts remains resilient, but longer marketing times open room to negotiate repairs or concessions. The clearest tactical opening is in attached homes. More inventory, softer bidding, and rising rents create a viable playbook for first-time buyers and investors. Families pursuing single-family homes still need competitive offers, but can press for stronger contractual protections. Condo buyers should prioritize newer or well-managed buildings with healthy reserves. Investors must stress test returns against higher insurance and HOA obligations.
Finally, a significant tax development is creating a powerful tug-of-war for long-time homeowners. On one side, the golden handcuffs are tighter than ever. A recent analysis shows median capital gains for sellers in the San Jose metro near $850,000, well above the $500,000 federal primary home exclusion for married couples. That gap means many sellers could face six-figure federal tax bills, plus state tax exposure, an acute deterrent to moving. On the other side, policymakers have offered temporary relief for households that stay. A federal change raised the SALT cap to $40,000 for the 2025 tax year, phasing out for higher incomes and slated to revert to $10,000 by 2030. For many Bay Area itemizers with large property and state income taxes, this provides a meaningful near-term cash flow benefit. Taken together, these tax dynamics strengthen the financial case for holding and upgrading in many instances.
Tax rules have long contributed to low turnover in the Bay Area. Current median capital gain levels amplify that inertia. The temporary SALT increase offers a near-term offset that can make refinancing or cash-out strategies to fund renovations and ADUs more attractive than selling and realizing a large tax bill. That dynamic is likely to keep supply constrained, supporting prices and encouraging owners to extract value by staying put. Practically, homeowners should work with a CPA to substantiate review Proposition 19 transfer rules and consult tax counsel before converting a primary residence to a rental or executing other major moves.
So what's the strategic play in a market broadcasting these mixed signals? For buyers, success requires micro-strategy rather than one-size-fits-all bids. The rate dip is headline-friendly, but the most actionable opportunities are in softer pockets. Attached homes in parts of the East Bay, for example, where buyers can negotiate terms, insist on thorough inspections, and sometimes secure seller-paid credits to lower initial ownership costs. For current homeowners, renovating rather than relocating looks increasingly attractive. High potential capital gains on sale, coupled with temporary SALT relief and windows for favorable refinancing, create an incentive to stay and invest in the property. A cash-out refi or HELOC to fund an ADU or remodel may be a superior wealth-building option compared with selling and triggering a large tax bill. And for investors, the rental rebound can lift yields, but disciplined underwriting is essential. Stress test every acquisition for rising insurance, HOA, and tax costs. The most promising assets are attached homes with upgrade potential in transit-oriented, employer-proximate locations.
That's your market intelligence update. Join us next week as we continue to track the trends shaping your real estate journey in the Bay Area. Thank you for watching.